Good evening, everybody. We are on the brink of something massive, something that could shake the very foundation of the global economy. The headline is stark. China and Japan, they're thinking about dumping trillions in US debt. This is not some small potatoes, folks. We're talking about the possibility of a financial earthquake. Why are these economic powerhouses suddenly getting cold feet about America's IOUs? And what happens if they decide to pull the plug? We're going to break it all down for you tonight. No BS, just the facts. This is the kind of stuff they don't want you to know, but we're here to make sure you do. Let's start with Japan, long considered America's best customer when it comes to debt. They've been buying our bonds for decades, propping us up, some might say. Right now, they're sitting on a mountain of US Treasury bonds, over $1 trillion worth. Think about that, $1 trillion. That's more than any other country on Earth. Why? Well, for years, it's been in their best interest. They buy our debt, it helps keep their currency weak, their exports strong. It's a symbiotic relationship, or at least it was. But things are changing. Japan's economy isn't what it used to be. They're facing their own challenges, an aging population, sluggish growth. And then there's China, breathing down their necks, vying for influence. So, the question becomes, how long can they keep buying? How long can they afford to hold? And what happens if they decide to cash in their chips? This is about real money, real consequences. Now let's talk about China. They're the second largest holder of US debt, nearing $1 trillion. But their relationship with the US is far more complicated. It's a delicate balance of power and economics. They need us, we need them. But there's also deep mistrust and rivalry. We've seen it with the trade war and tariffs. That tension spills into the financial realm. Holding so much US debt gives China leverage. They can dump those bonds, causing global shockwaves. It's a dangerous game of chicken. China's diversifying, looking for other currencies. They're looking at gold, the euro, and alternatives to the dollar. And that should scare everyone. Stay with me. Now, let's shift gears and talk about the United Kingdom. They're our closest ally, our partners in everything from trade to defense. And when it comes to US debt, they've always been there for us, a reliable buyer, a steady hand. But even the strongest bonds can be tested, and the UK is facing its own set of challenges. Brexit has been a mess, dividing the country, shaking its economy. And now, with a new prime minister at the helm, there's uncertainty about the future, about their relationship with the US. They're still holding over $650 billion in US debt. But for how long? They're looking at the same things as everyone else: the rising deficit, the political instability, the possibility of inflation. And they have to be asking themselves, is America still a safe bet? Now, let's talk about a country you might not expect: Luxembourg. It's tiny, smaller than Rhode Island, but don't let that fool you. This place is swimming in money, a global hub for finance, a magnet for multinational corporations. And when it comes to US debt, they've been a big player, holding hundreds of billions of dollars worth of bonds. But why? What does a country like Luxembourg get out of propping up the American economy? Well, it's complicated. Some of it is about stability, about finding a safe haven for their investments. But a lot of it is about what's known as tax optimization, a fancy way of saying finding loopholes, minimizing their tax burden. And that's where things get murky. Let's move on to another small country with a big footprint in finance: Ireland, known for its rolling green hills, pubs, and rich culture. But also a haven for tech giants like Apple and Google. They're there for tax breaks and favorable regulations, and that money often ends up in US Treasury bonds. American companies avoiding taxes, lending money back to the US government. Ireland holds over $320 billion in US debt. We're heading to the heart of Europe now, to Belgium. Now, Belgium might be known for its chocolate, its beer, its waffles. But it's also a major player in the global financial system, home to the headquarters of the European Union, a hub for international banks and multinational corporations. And all that money flowing through Belgium, it needs a place to go. And where does it end up? You guessed it, US Treasury bonds. Belgium is sitting on a pile of American IOUs, over $270 billion worth. But here's the thing about Belgium. It's not just about Belgian money. Because of its central location, its role in the EU, Belgium has become a kind of financial black box. Money flows in from all over the world, gets shuffled around, invested in various assets, including US debt. So, when we talk about Belgium holding American debt, we're really talking about a whole network of actors. Let's talk about Switzerland now, a country synonymous with secrecy, with neutrality, with, well, banks. For decades, Switzerland has been the go-to destination for the world's wealthy elite looking to shield their assets from prying eyes. And when it comes to US debt, Switzerland has been a major player, holding hundreds of billions of dollars worth of bonds. Now, some of that is legitimate investment, Swiss pension funds looking for a safe haven for their money. But let's be honest, a lot of it is shrouded in secrecy, hidden behind layers of shell corporations and numbered accounts. It's money that's often fleeing instability, fleeing taxes, fleeing accountability, and that creates a dilemma for the US. On the one hand, we need countries like Switzerland to keep buying our debt, to keep the money flowing. But on the other hand, we're increasingly uncomfortable with the lack of transparency. We're heading offshore now, to the Cayman Islands, a tiny archipelago in the Caribbean, a place synonymous with tax havens, with shell corporations, with hiding money from, well, just about everyone. Now, the Cayman Islands might be small, but they're sitting on a mountain of US debt, over $240 billion worth. How is that possible? Well, it's all about the game of global finance, a game played by different rules, a game where corporations and the ultra-wealthy can stash their cash far from the reach of tax collectors and regulators. And the US government? Well, we're caught in a bind. We need these countries to keep buying our debt, to keep the system afloat. But at what cost? Because every time a corporation dodges taxes by funneling their profits through a place like the Cayman Islands, it's the American taxpayer who ends up footing the bill. It's a system that's rigged, and it's time we started asking some tough questions. We're moving to Asia now, to Taiwan, an island nation facing enormous pressure from mainland China. And in the midst of this geopolitical tug-of-war, there's another battle being waged, a financial one. Taiwan holds over $220 billion in US debt, making it one of the largest foreign creditors to the United States. But this isn't just about economics, it's about strategy, about survival. Taiwan sees its holdings of US Treasury bonds as a lifeline, a way to curry favor with Washington, to ensure continued American support in the face of Chinese aggression. But this strategy comes at a cost. If the US dollar were to weaken, if interest rates were to rise, Taiwan's economy could be severely impacted. It's a delicate balancing act, and the stakes couldn't be higher. Finally, let's talk about India, a rising economic powerhouse with a rapidly growing middle class. India's been on a tear in recent years, its economy booming, its influence expanding. And as India's star has risen, so too has its appetite for US debt. They're now holding over $210 billion worth of treasury bonds, and that number is only going up. Now, for India, this is about diversification, about finding a safe haven for their growing foreign exchange reserves. But it's also about hedging their bets, about reducing their reliance on the US dollar. Because India, like many other countries, is looking at the long game. They see the challenges facing the US economy, the political gridlock, the rising debt. And they're starting to wonder if the American century is coming to an end. So, there you have it. We've traveled around the world, looked at the balance sheets of nations, and uncovered the uncomfortable truth about who really holds America's debt. And the picture that emerges is one of complexity, of interconnectedness, of a global financial system that's teetering on a knife's edge. The decisions made in Beijing, in Tokyo, in London, in capitals around the world, they will have a direct impact on your life, on your future, on the world your children will inherit. This is not a time for complacency. This is a time for awareness, for engagement, for demanding better from our leaders. Because the future of the global economy, it's not a game, it's our reality. As we delve deeper into the labyrinth of global finance, one crucial aspect remains the ripple effect of US debt on emerging markets. These nations, often seen as the growth engines of the future, are not isolated from the tremors of the world's largest economy. When the US sneezes, emerging markets catch a cold. Pause once. Countries like Brazil, India, South Africa, and Indonesia are particularly vulnerable. Their economies are often heavily reliant on foreign investment and exports. When confidence in the U.S. economy wanes, investors seek safer havens, pulling capital out of these emerging markets. This outflow can lead to currency devaluations, inflation spikes, and economic instability. Pause ones. But it's not just about capital flows. The cost of borrowing for these nations is directly tied to the interest rates set by the Federal Reserve. Higher U.S. interest rates mean higher borrowing costs for emerging markets, stifling their economic growth and development projects. Pause ones. Moreover, many of these countries hold significant amounts of U.S. debt themselves. A sudden shift in the value of the dollar or a change in U.S. economic policy can have profound implications for their own fiscal health. It's a delicate dance of dependency and resilience, of opportunities and risks. Pause ones. In an interconnected world, the economic fates of emerging markets and established powers are intertwined. The decisions made in Washington, the policies enacted on Wall Street, they reverberate across continents, shaping the lives of billions. Pause ones. So, as we ponder the future of the global economy, let's not forget the emerging markets. Their stories, their struggles, and their successes are integral to the tapestry of our shared financial destiny. Because in the end, we're all in this together, navigating the complexities of a world where every economic decision sends ripples across the globe. To fully understand the current dynamics of U.S. debt and its global ramifications, we must first look back at its historical context. The story of U.S. debt is one of ambition, power, and economic strategy, stretching back over 2 centuries. Pause ones. From the Revolutionary War to the Great Depression, and from World War II to the financial crisis of 2008, each period has shaped the contours of the nation's debt landscape. In the aftermath of World War II, the United States emerged as a global superpower. The Bretton Woods Agreement of 1944 established the U.S. dollar as the world's primary reserve currency, cementing its pivotal role in global finance. This gave the U.S. a unique advantage, the ability to borrow extensively while maintaining international confidence. Pause ones. Throughout the Cold War, the U.S. government issued debt to fund both military expenditures and social programs, leveraging its economic might to exert geopolitical influence. The Reagan era of the 1980s saw a significant increase in national debt due to tax cuts and increased defense spending, a trend that has persisted in various forms to this day. The global financial crisis of 2008 marked another watershed moment. Massive government bailouts and stimulus packages were financed through increased borrowing, pushing U.S. debt to unprecedented levels. The world's interconnected financial systems meant that tremors in the U.S. economy sent shockwaves across the globe. Today, U.S. debt stands as a towering figure, influencing global markets and economic policies. Countries around the world hold trillions in U.S. Treasury securities, making them stakeholders in America's fiscal health. The decisions made in Washington about debt management and economic policy have far-reaching implications, affecting everything from global interest rates to international trade dynamics. Understanding this historical context is crucial. It provides insights into why the world watches U.S. debt so closely, and why any shifts in its trajectory can cause ripples, or even waves, across the global economy. History has shown us that while the U.S. may be the biggest player, it is not isolated from the consequences of its fiscal choices. As we navigate the complexities of today's economic landscape, let's remember the lessons of the past. They remind us that the story of U.S. debt is not just about numbers on a balance sheet. It's about the interconnected destinies of nations, economies, and people around the world. Pause twos. While individual countries navigate their fiscal policies and debt management strategies, international organizations play a pivotal role in maintaining global economic stability. Pause ones. These institutions act as both overseers and supporters, ensuring that the interconnected web of global debt does not unravel into chaos. Pause ones. The International Monetary Fund, or IMF, stands at the forefront. Established in the aftermath of World War II, its primary mission is to ensure the stability of the international monetary system. The IMF provides financial assistance to countries facing balance of payments problems, helping them stabilize their economies. In return, these countries often agree to implement economic reforms aimed at restoring growth and ensuring debt sustainability. Pause ones. The World Bank, another key player, focuses on long-term economic development and poverty reduction. By providing financial products and policy advice, the World Bank helps developing countries build infrastructure, improve education, and enhance healthcare systems. These efforts indirectly contribute to global debt management by fostering economic stability and growth in some of the world's most vulnerable regions. Pause once. The G20, an international forum for governments and central bank governors, also plays a crucial role. It brings together the world's major economies to discuss and coordinate economic policies. During times of financial crisis, the G20 has acted as a platform for collective action, facilitating coordinated responses to stabilize the global economy. Pause ones. Additionally, regional organizations like the European Union and the African Development Bank contribute to managing debt within their respective regions. The European Central Bank, for instance, has implemented various measures to support Eurozone countries facing debt crises, while the African Development Bank provides financial and technical assistance to its member countries. Pause ones. These international organizations are not without their critics. Some argue that the conditions attached to financial assistance can be too stringent, potentially exacerbating economic hardships. Others believe that the influence of these institutions can sometimes undermine national sovereignty. Nevertheless, their role in managing global debt remains indispensable. Pause ones. In an increasingly interconnected world, the actions of one country can have far-reaching impacts. International organizations serve as a stabilizing force, helping to mitigate these impacts and fostering a collaborative approach to global economic challenges. Pause ones. As we look to the future, their role will likely become even more critical, ensuring that the global economy can navigate the complexities of debt management in a sustainable and equitable manner. Pause twos. Imagine a world where the United States, the largest economy on the planet, defaults on its debt obligations. Pause ones. The mere thought sends ripples of anxiety through global markets, but what would the actual consequences be? Pause ones. First and foremost, a U.S. debt default would trigger a financial shockwave. Pause ones. The U.S. dollar, the cornerstone of global trade and finance, would lose its status as the world's reserve currency. Pause ones. Investors would flee to safer assets, causing unprecedented volatility in financial markets. Pause ones. Stock markets would plummet, and bond yields would skyrocket, leading to a sharp increase in borrowing costs for governments and corporations alike. Pause ones. The impact on the U.S. economy would be catastrophic. Pause ones. Government services would grind to a halt, as the federal government would be unable to pay its bills. Pause ones. Social security checks, military salaries, and other essential payments would be delayed or suspended. Pause ones. The resulting economic paralysis could push the country into a deep recession, or worse, a depression. Pause ones. But the fallout wouldn't stop at America's borders. Pause ones. Global trade would be severely disrupted, as the U.S. is a major trading partner for many countries. Pause ones. Export-dependent economies would suffer, leading to a cascade of economic downturns worldwide. Pause ones. Moreover, the trust in U.S. Treasuries, long considered the safest investment, would be shattered. Pause ones. Central banks, pension funds, and other institutional investors would be forced to reconsider their portfolios, spreading uncertainty and fear throughout the financial system. Pause ones. The geopolitical ramifications could be equally severe. Pause ones. U.S. allies might question America's reliability, while adversaries could see an opportunity to challenge U.S. dominance. Pause ones. International alliances and partnerships would be tested, and the global balance of power could shift in unpredictable ways. Pause ones. Pause ones. In the face of such a crisis, international organizations like the IMF and the World Bank would play crucial roles in attempting to stabilize the situation. Pause ones. Emergency meetings of the G20 would likely be convened, seeking coordinated actions to mitigate the damage. Pause ones. Yet, the scale of the crisis might overwhelm even these robust institutions. Pause ones. Pause ones. While a U.S. debt default remains a hypothetical scenario, its potential consequences underscore the interconnectedness of the global economy. Pause ones. It serves as a stark reminder of the importance of fiscal responsibility and international cooperation in maintaining economic stability. Pause ones. Pause ones. As we navigate the complexities of global debt, the specter of a U.S. default looms as a powerful incentive to find sustainable solutions and to ensure that the pillars of the global financial system remain unshaken. Pause twos. The political ramifications of U.S. debt extend far beyond economics. Pause ones. As the world's largest economy grapples with its financial obligations, the ripple effects can be felt in diplomatic corridors and international summits. Pause ones. U.S. debt has the power to either strengthen or strain global alliances, reshaping the geopolitical landscape in profound ways. Pause ones. Pause ones. First, consider America's closest allies. Pause ones. Nations in Europe and Asia that rely on the U.S. for security and economic partnerships may find their trust tested. Pause ones. If the U.S. struggles to manage its debt, questions will arise about its ability to fulfill its defense commitments and maintain its role as a global leader. Pause ones. This uncertainty could lead allies to seek new partnerships, potentially realigning global power structures. Pause ones. Pause ones. In regions like the Middle East and Africa, where U.S. influence has been pivotal, debt-related instability could open doors for other powers to step in. Pause ones. Countries like China and Russia, with their own strategic interests, might seize the opportunity to expand their influence, offering economic and military support to nations looking for alternatives to the U.S. Pause ones. Pause ones. The impact on international organizations cannot be overstated. Pause ones. Institutions like NATO, the United Nations, and trade agreements such as the USMCA could face unprecedented pressure. Pause ones. The ability of these entities to function effectively hinges on the stability and reliability of their member states, particularly the U.S. Pause ones. A financially unstable America could weaken these organizations, undermining global governance and cooperation. Pause ones. Pause ones. Moreover, the political discourse within the U.S. itself would likely shift. Pause ones. Domestic debates over debt management, spending cuts, and tax policies could become even more polarized. Pause ones. This internal strife might weaken the U.S.'s negotiating position on the global stage, as other countries perceive a distracted and divided America. Pause ones. Pause ones. The broader implications extend to global trade policies. Pause ones. As the U.S. navigates its debt challenges, protectionist sentiments could rise, leading to trade wars and tariffs that disrupt international commerce. Pause ones. Countries dependent on U.S. trade might find themselves caught in the crossfire, forced to adapt to new economic realities. Pause ones. Pause ones. Ultimately, the political fallout of U.S. debt is a multifaceted issue with no easy solutions. Pause ones. It underscores the interconnectedness of economic and political stability, reminding us that financial decisions made in Washington can reverberate across the globe. Pause ones. Pause ones. As nations watch closely, the world braces for the potential shifts in alliances and power dynamics that may arise from America's financial crossroads. Pause twos. As nations grapple with the uncertainty surrounding U.S. debt, they are actively exploring strategies to mitigate the associated risks. Pause ones. These measures are designed to protect their economies and ensure financial stability in the face of potential volatility. Pause ones. Let's delve into some of the key strategies being considered by countries worldwide. Pause ones. Pause ones. Diversification of foreign reserves is a primary tactic. Pause ones. Rather than holding a significant portion of their reserves in US dollars, countries are increasingly looking to diversify into other currencies and assets. Pause ones. This approach spreads the risk and reduces dependence on the US economy. Pause ones. For example, some nations are increasing their holdings in euros, yen, and even gold. Pause ones. Pause ones. Another strategy involves increasing bilateral and multilateral trade agreements that bypass the US dollar. Pause ones. By conducting trade in their own currencies or through currency swaps, countries can reduce their exposure to fluctuations in the dollar's value. Pause ones. This move not only mitigates risk, but also strengthens regional economic ties. Sovereign wealth funds are also playing a crucial role. Pause ones. Many countries are leveraging these funds to invest in a diversified portfolio of global assets. Pause ones. This long-term investment strategy helps stabilize national economies by providing a buffer against potential losses from US debt holdings. Pause ones. Nations like Norway and the UAE are leading the way in this approach. Pause ones. Additionally, some countries are focusing on bolstering their domestic economies to reduce reliance on external debt. Pause ones. By investing in infrastructure, technology, and education, they aim to create more self-sufficient and resilient economies. Pause ones. This internal strengthening can help mitigate the impact of global financial instability. Pause ones. Engaging in international diplomatic efforts is another key strategy. Pause ones. Countries are working together to establish frameworks and agreements that promote financial stability and transparency. Pause ones. These collaborations can help manage the risks associated with US debt and foster a more stable global financial system. Pause ones. Lastly, some nations are taking a more cautious approach by gradually reducing their holdings of US debt. Pause ones. This methodical divestment allows them to minimize potential losses without causing abrupt market disruptions. Pause ones. China and Japan, two of the largest holders of US debt, have been observed slowly decreasing their positions. Pause ones. In conclusion, the strategies employed by countries to mitigate the risks of holding US debt are as varied as they are vital. Pause ones. By diversifying reserves, strengthening domestic economies, and fostering international cooperation, nations are taking proactive steps to safeguard their financial futures. Pause ones. These measures underscore the importance of adaptability and foresight in navigating the complexities of the global economy. Pause ones. As the world continues to monitor the situation, these strategies will be key in maintaining stability amidst the ever-evolving landscape of US debt. Pause twos. As we look to the future, the global debt markets are poised for significant shifts that could reshape the financial landscape. Pause ones. Understanding these trends and their potential impact is crucial for policymakers, investors, and economies worldwide. Pause ones. Let's explore some of the key predictions for the future of global debt markets. One major trend is the increasing role of emerging markets in the global debt arena. Pause ones. Countries like India, Brazil, and Indonesia are expected to see substantial growth in their debt issuance as they continue to develop their economies. Pause ones. This shift will diversify the sources of global debt and introduce new dynamics into the market. Pause ones. Another significant trend is the rise of sustainable and green bonds. Pause ones. As the world grapples with climate change, there is a growing demand for investments that support environmental sustainability. Pause ones. Green bonds, which finance projects aimed at combating climate change, are likely to become a more prominent feature in the global debt market. Pause ones. This shift not only addresses environmental concerns, but also attracts a new wave of socially conscious investors. Pause ones. The digital transformation of financial markets is also set to influence global debt trends. Pause ones. Blockchain technology and digital currencies are revolutionizing how debt is issued, traded, and managed. Pause ones. These advancements promise greater transparency, efficiency, and security in debt transactions, potentially reducing the costs and risks associated with traditional debt instruments. Pause ones. Geopolitical factors will continue to play a crucial role in shaping the future of global debt markets. Pause ones. The ongoing trade tensions, regional conflicts, and shifts in global alliances can create volatility and uncertainty. Pause ones. Investors will need to navigate these complexities carefully, balancing risks and opportunities in a constantly changing geopolitical landscape. Pause ones. The trend towards de-dollarization is also expected to gain momentum. Pause ones. As countries seek to reduce their dependence on the US dollar, alternative currencies and regional trading blocs will become more prominent. Pause ones. This shift could lead to a more multipolar financial system, with multiple currencies playing significant roles in global trade and finance. Pause ones. In conclusion, the future of global debt markets is marked by a blend of opportunities and challenges. Pause ones. The rise of emerging markets, the push for sustainability, digital innovations, and geopolitical shifts will all shape the landscape in the coming years. Pause ones. By staying informed and adaptable, stakeholders can navigate these trends and harness the potential benefits while mitigating risks. Pause ones. As we move forward, the evolution of global debt markets will continue to be a critical factor in the stability and growth of the global economy. Pause twos.